Imagine knowing which direction the market is going to move before the opening bell even rings. You don't need a crystal ball to figure out if prices are heading up or down. You just need a measurable, repeatable framework. That framework is built on a single core concept, the daily bias. This is how you lock in your daily directional target. Start by drawing horizontal lines at the previous day's high and low. If today's solid candle body closes clearly above yesterday's high, your bias for tomorrow is bullish. If it closes below yesterday's low, your bias is bearish. By establishing this baseline rule, you give yourself an objective directional filter. You drastically reduce the odds of jumping into a doomed trade before the market even opens. But financial markets rarely offer perfectly clean breakouts. In reality, price movements are messy, and those messy edges are where beginners get caught out. Look at this sketched candlestick. The price drops below the previous day's low, but snaps back up. The solid body closes inside the lines, leaving a long lower wick. This is a liquidity sweep. It's a trap. It captures impatient sellers who jumped in early. Because those sellers are trapped, we use a counterintuitive rule. A wick break below the previous day's low means your bias for the next day is actually bullish. The exact same math applies on the high side. If the price sweeps the high but only leaves a wick, your bias for the next day becomes bearish. By identifying these wick breaks as traps rather than true breakouts, you avoid early losses and start capitalizing on the very reversal stopping everyone else out. So we know how to handle clean breaks and wick sweeps, but what happens when the market simply pauses and refuses to break out at all? In this diagram, you see a large initial candlestick. We call this the mother candle. The very next day, the price stays entirely within the high and low range of that mother candle. This is an inside bar. When you see an inside bar, the rule is strict. You do nothing. You do not redraw your boundary lines. You keep them locked on the mother candle and wait. Let's test this. Here's a 3-day sequence. Day 1 sets the range. Day 2 is an inside bar. On day 3, the price drops below the day 1 low, but closes back inside with a massive lower wick. What's your bias for day 4? Your bias is bullish. Day 3 swept the day 1 low's liquidity, triggering our trap rule. Waiting for that definitive sweep requires patience, but mastering that patience always keeps you safe while the rest of the market chops itself to pieces during consolidation. Even with the correct bias, impatience can still ruin a trade. A bullish daily bias does not mean you smash the buy button the second the market opens. To find a safe entry point, we have to look inside the daily candle. We drop down to a smaller time frame, like the 1-hour chart. New traders see a bullish daily bias and immediately buy the peak of the morning price spike. The correct execution strategy is to wait for the price to pull back down to a logical intraday support level. Once you see a bullish confirmation candle form at that support line, you have a safe entry with a strong risk-to-reward ratio. The daily bias dictates what direction you are going to trade. Dropping to the lower time frame dictates exactly when and where you enter to protect your capital. Every scenario we've covered today boils down to one simple, repeatable checklist. Take a look at this matrix sketched on the notebook paper. Body break high is bullish. Body break low is bearish. Wick break high is bearish. Wick break low is bullish. And you always execute on lower time frame pullbacks. Take a screenshot of this list, tape it next to your monitor, or keep it in your trading journal. By applying this specific rule-based matrix every single morning, you strip the emotion out of your decisions and turn daily market chaos into a predictable, mechanical system.